Larry, one of the reasons why we value you so much as a contributor is that you are willing to change your views in the face of the evidence. There's been a fair amount of evidence this week. Have you changed any of your views about where we stand with this crisis?
I think this is going to be longer and more serious than I thought several weeks ago. That's because the data surprises were all negative, retail sales worse, industrial production worse, unemployment claims higher. That's because the problems in the financial system down the road from cascading defaults have come more clearly into view. That's because I have a clearer sense of the international difficulties and how they're not being attended to. And most importantly, with Singapore having to reverse itself and lock people up again, I've got a much greater sense of the complexity of any kind of return for the economy to normal conditions, and a sense that that's going to take a very long time. So my sense is that this is not going to be a V. It's probably not going to be all the way to being an L, and there may well be a W aspect in this recovery.
So, Larry, you talk about the complexity of getting the economy going again. What about the risk involved? Because you had a lot of talk from the president and others this week about getting us back to work. What are the risks in that? How do you assess that?
Look, all kinds of athletes have ruined their careers by trying to come back too quickly after injuries or after health problems. I had a serious injury a year ago. I wanted to try to go play tennis, go play golf. My doctor said if you do that, you risk re-injuring your legs and having to go right back to the beginning again. That's the way it is here. And I think if we go rushing back, we're going to be back to lockdown, and it's going to be much harder economically, psychologically, and politically than it was the first time. And so I think that would be a very serious error, particularly a very serious error if we don't have pervasive testing and contact tracing in place, and we're still moving too slowly on those things. So very often when you rush, you end up getting to your destination more slowly. And I'm worried that we're going to make mistakes in that direction. Look, if we go too fast, it's an irreversible error and we're back to locking up. If we go a little slower, and it turns out that we've overprotected, then we'll be able to fix that mistake.
So, Larry, you say that you think it's going to take longer and be more difficult, riskier, more complex coming back from this. And yet the stock market was up for the second week in a row this week. Does the market know something about this that you don't?
Possibly, and it's always a mistake to ignore the message in markets. On the other hand, the market had nearly half a dozen rallies of 20% or more between 1929 and 1933. The market had a major rally in the period after Lehman, before the collapse at the beginning of 2009. The market had several periods when it rallied during 2008 before reaching its bottom. So false dawns are ubiquitous in the history of stock market fluctuations. And I think it would be a serious mistake to take too much comfort from what's happening in the market, given all the difficulties that lie ahead in the economic forecast. I mean, think about it this way. It would be an odd thing if, well before the trough of a recession, that was the most serious recession by a factor of 3 in 70 years, the stock market was only down by 15%, and that it wasn't going to go down further as that recession took hold, particularly when there's news to come about relapses on the health side, about the difficulties potentially in the financial system, and certainly about what's going to happen in emerging markets on which many U.S. companies are very, very much depend on. So nobody can predict the stock market, but I think it'll be a mistake to read great optimism from what's happening in the stock market.
How much of the market is betting on the Fed? Because one difference from all those other recessions is the Fed has stepped up even more than they did back in the great financial crisis.
I mean, the Fed is providing very low, hyper low interest rates, so there's no place to go, other place to go to get yield. The Fed is supporting the borrowing of large numbers of companies. The Fed is injecting huge amounts of liquidity into the system. The Fed is literally buying exchange traded funds made up entirely of junk bonds. And many people think that at some point that if things were to turn down, that the Fed would be prepared to buy equities. So I think this is, you're right, David, this is very much a bet on what the Fed is going to do. And I think what we know from lots of financial history is that policy can rig markets away from fundamentals for a while, but it can't do that forever. And these fundamentals look pretty difficult to me. So look, I'm not here to give your listeners and your viewers investment advice, but I think anyone who thought that, oh, the stock market's up, therefore we can relax, in the midst of every serious recession in U.S. history, there would have been substantial opportunity to make that mistake. And so I don't think it would be wise to take any great faith from that.
Yeah, and finally, Larry, one of the things that's coming clear is, as difficult as it's been here in the United States, what some of the countries around the world, particularly the poorest countries, are facing could be much, much worse. What do you make of the G20 and their decision to suspend debt payments at least through the end of the year?
That was a good useful thing to do, but the really tragic truth about the G20 meeting was that the countries of the G20 have a philosophy: whatever it takes, break every rule, ignore moral hazards, massive deficits, massive liquidity at home, and crumbs off the table for supporting the international community. 6 months of a useful debt relief measure doesn't remotely approach what's necessary with respect to the worst global financial crisis since the Second World War. It was a vision-free G20. That is not the fault of the heads of the international financial institutions. That is the fault of the major shareholders of the international financial institutions. Frankly and sadly, it must be said, primarily the major shareholder, the United States. We should be doing everything, we should be doing equally shocking things to fortify the liquidity and the quantity of lending and the provision of funding from the international financial institutions and the providing for debt relief. We should be acting as far from the norms there as the Fed is acting, or the European Central Bank is acting, or the Bank of England is acting. And when we've done that, we will have had a global community response. But we are far, far short of that, and it's very sad.
Yep.
And the chickens are going to come home to roost. Yep. And frankly, it's a geopolitical big deal as well, David.